Hello, everyone. My name is Nathan Kolb, and it is my privilege to welcome you to today's Creditsafe webinar. Today, we're going to be discussing the trends and insights and different things going on specifically in credit in Canada. And it's going to be a little bit of a different type of webinar here. We're going to have three speakers here today. I know you only saw one on that first slide, but I promise you there'll be three today. And it's a joint webinar today between Creditsafe Canada, Creditsafe US, and Equifax. And we've got a great strategic partnership, especially in Canada, that we're going to talk about here in a minute and discuss, and that all of these different entities are going to be contributing today to the data we're going to hear about and everything that's going on. So I don't need to be the one speaking nearly as much as these gentlemen that are going to be joining me today. They're the experts in this, and that's who you came to see. So I want to make sure we get right to them. So first, Steve, why don't you introduce yourself, Steve Carpenter, and give us a little insight onto what's going on and why you're here today.
Yeah, perfect. Thanks, Nathan. So hi, everyone. I'm Steve Carpenter. I'm the country manager of Creditsafe in Canada. And I'm working very closely with the Equifax team in Canada, with whom we have the strategic alliance that Nathan mentioned. So I'm joined by Kevin Freeland and Jeff Brown from Equifax today. They've got some great insights into the Canadian market, the trends we've been seeing over the last 12 months that they're going to share. And then we're going to sort of blend that with what we're seeing on a global level as well. So not just US, not just Canada, what we're seeing globally when it comes to delinquencies, bankruptcy rates, days beyond terms, and what we can expect in the future as well. So with that said, I'll pass over to Jeff to give a quick introduction to himself as well.
Perfect. Thanks, Steve. So I'm Jeff Brown. I'm head of strategy and innovation for small business here at Equifax Canada. Been with Equifax for just over 5 years. So I work with a lot of the fintech lenders, a lot of the major banks, in really going through and trying to dissect what's happened here over the past 12 months with the pandemic, and really try to bring that crystal ball out to figure out exactly what's going to be happening here over the next year or so as well. So glad to be joined by Kevin Freeland, my colleague, and I'll pass it over to Kevin. Kevin, I think you're on mute there. Sorry.
Thank you for that, Jeff. Yes, I was. Thanks, Steve, and thanks, Jeff. So Kevin Freeland, Equifax Canada. I spent 36 years in the commercial information space. I do a number of roles, but most importantly, I work with Steve closely on a lot of the Canadian / Creditsafe strategic initiatives, and enjoying that relationship.
Great. So as you can see, folks, we've got a great lineup here today and everything. And one thing we do want to start with, and I failed to mention earlier, we want this to be a discussion. We don't want this to just be these guys talking to you, a bunch of talking heads speaking at you. We want to speak with you, and we want to discuss this with you. So the way we're going to do that is we're going to be asking you some questions throughout this time that we're together. And the way you answer is down at the bottom of your screen, there's a little text bubble with Q&A. Go ahead and just type in your answer. I'm already monitoring that. I will monitor that the entire time, and I will give all the answers to, or groups of aggregate of the answers to our speakers so they can talk about that. And to start us off, if you guys would just tell us if you are trading within North America. So does your company trade within North America, yes or no, or where else do you trade? So if you're outside of North America, where else? Give us an idea of where else you're trading. So like I said, just go down to that Q&A, drop in an answer for us on yes, we're just in North America, no, we're not, and this is where this is the other places we're trading. So while that's going on, let's dive right into this. Steve, I see you popped up the presentation already. And my first question to you guys is, we know things are changing. We know stuff is going on. We know that everything's adjusting. What trends are you guys seeing? And as you can see from the slide, specifically with small business credit trends, what are you seeing right now?
Yeah, thanks for that, Nathan. And as we go through and look at what's happened here over the past year, it's really interesting to see what's happened over the past 6 months specifically. So just like you've experienced in the US, we've had a lot of government funding that's come into our market. And with that, it's really shaken up the way that credit is usually extended. So from the major banks to the major suppliers, the amount of credit that is available has really reduced. So when we look at this chart here in the top left, we have two different ways that data comes into us at Equifax. We have financial trades, which is small business banking data that comes in from the major banks here in Canada. And then we have the other in industrial trades. And this is the account receivable information that comes in across from suppliers in and across Canada, the Fortune 500 that report their tens, if not hundreds of thousands of small businesses that they work with. And really what the pandemic has done has really impacted the financial institutions. So typically the average ticket size, your average line of credit that's extended from a bank is in and around $40,000 to $50,000. Here in Canada, there was the Canadian Emergency Business Account that was set up where any small business could go through and apply for it as long as they met a few criteria. And of the 1.2 million small businesses here in Canada, 800,000 actually ended up taking up those loans. So as you can see from the amount of net new trades that financial institutions have seen, it's actually reduced by in and around 50%. So it has really impacted their bottom line, and really will continue as the pandemic does unfold. If we look at the industrial trades, for example, less so. And really what we're seeing is while some small businesses have really gone kind of inactive or really had to kind of hunker down here during lockdowns, these trades are still happening. It's just the amount of dollars that's actually being extended out isn't as great. So really what it shows us is that the small business loans that they're getting from the government that are at interest free over the next 2 years have really been used to pay off debts, have been used to kind of keep the businesses up and running. What is concerning though, when we look here at the top right, is the inquiry volumes. So the inquiries are measurements that we get from any supplier that works with us to pull a credit report. And so when they pull a credit report, we have the idea that there's some onboarding, some origination, some portfolio reviews that an organization is doing. And really what we've seen here over the past 3 months or the last 3 months of 2020 was that really shrunk down. And really what that tells us is that, we were going through lockdowns, the credit wasn't being extended. Anybody who's operating in an e-commerce perspective was able to kind of still keep their business up and running, but really the inquiry volume had decreased quite a bit. And not surprising, the oil and gas industry here in Canada, across Alberta, was really impacted. Construction retail was as well, but not to the same degree as we've seen the oil and gas space. Next slide. So when we look at this, we also think about another segment of our business here in Canada, and that's the Canadian Finance and Leasing Association. So what we do to work with them and the people within that jurisdiction. And so when you look at equipment leasing and financing, that has been impacted quite dramatically as well. So retail brick and mortar has really seen the amount of originations that have happened there has declined quite dramatically. But actually in the agriculture space, you think of kind of the upstream, people are consuming more goods at home rather than going out to restaurants. So it means there's an incoming amount of goods into grocery stores a bit more than was happening before. So it's really seen a bit of a boom in that space. So anybody who is lending in and around that area, the delinquency rates are usually less than 2%. So really good area to be investing in, but everything else, if you look at these index volumes, has really declined. What's actually counterintuitive with this as well is the loan performance. So the delinquency rates on these have actually gone through to historic lows. And that's just like we were talking about in the previous slide, is that government funding is really keeping things alive. And it's really halted on the negative occurrence credit life cycle that's happening within Canada. So something we're keeping an eye on, and you're going to hear that kind of throughout the next half hour here as well. So next slide.
So Jeff, let me just drop in here real quick. We've had a bunch of answers in from our first question, just so that you guys know kind of who's in the room. Most of the businesses, most of the companies that are in here, paying attention here, are actually doing business just in North America. We do have a few that are doing stuff abroad, Europe, Middle East, that type of stuff. But most of the businesses are really affected specifically by what's going on in North America. So, the stuff that you're talking about here should hit home really, really well for everybody as you're going through these trends.
Perfect. That's really great to hear. In terms of onboarding, working with customers here in North America, it's great to be able to have that view. So you have kind of a closed circuit for knowing who you're dealing with. I think as we go through some of the use cases here later on, we'll understand exactly how that's something you have to keep in mind about what's happening globally that's going to impact you here locally as well. So thanks for providing that across, Nathan. When we talk about the delinquency rates here in Canada, so there's been kind of a cycle that happens. So typically when we look at account receivables, we monitor things in 30, 60, 90 days past due. Then they go to collections, they go to legal, and then they end up going to bankruptcy. So as a tail indicator, people typically want to look at bankruptcies and say, okay, well, hey, pandemic's been happening. How many businesses are shut down? How bad is it for the economy? We can't look at that the same way anymore. We have to look at, deferrals that have been offered from banks, from suppliers. And so this really kind of pushed that 30, 60, 90 down a little bit further. Compounding that, you look at collection companies, and they haven't been able to operate the same way either. They haven't been doing outbound calls. So again, that kind of pushes things back even further. And then courts have been closed. So basically anything that is trying to go through legal proceedings hasn't been able to happen as well. So this whole government funding has been great to keep businesses up and live and running. But at the same time, it's really compounded this negative current cycle that's happened. So we look at the delinquency rates here over the first quarter of last year. We did see an upward trends in the number of delinquencies that had happened. And we're seeing this predominantly affect the financial institutions. So not only the originations actually coming in a bit lower, but it's specifically hitting Alberta, New Brunswick, and Quebec. So it's good to keep in mind as you think about regional impact. And the good thing with this as well is we saw the number of originations happening in the industrial side is actually seeing quite a bit of a boom. So the idea that that credit is being extended from the government is being used to help utilize and support suppliers in and across Canada.
Yeah, and Jeff, as you're talking about this, I mean, there's so many factors that go into what's happening here, and one of those that we've seen across the world is supply chain. And I know you guys are going to talk about that and everything, but we did want to ask the folks in the audience today. Have you seen, whether it's because of the stuff with the Suez Canal or the lockdowns or different things going on, have you seen a disruption in your supply chain? And if so, what specifically are you seeing? Are you seeing it on arrivals, on raw materials, on what? What are you seeing if you are seeing a disruption? And if you're not, just let us know that you're not. But again, just drop into those comments there. Drop your comments on that question into the Q&A. And if you have any other questions as the speakers are going through, please feel free to drop those in there as well. And I'll be happy to break in and just interrupt these guys, because that's just part of my job, is to get to interrupt them and then ask your questions for you. So feel free. But again, are you seeing those disruptions, those problems, those issues within your supply chain? And if so, kind of what are they?
Perfect. So great segue in across to Steve. So Steve, you have some highlights to kind of talk about from a global perspective.
Yeah, I think that leads nicely onto what we've seen US, but also across Europe. So countries where Creditsafe, where we hold data assets, so across most of Western Europe, across US, we've looked at sort of days beyond terms. So on average, how late are companies paying their bills? And you can see from this, it's pretty much been constant. It's flatline across all of these countries. Before looking at this, I'd have expected to see like a surge of late payments around sort of April, May, June last year, but that's not what we've seen. And a lot of it comes back to, as well, as like Jeff mentioned, government funding, also the number of trades that have been reported. So we've seen the number of trades drop. So while the actual days beyond terms have remained fairly constant, the actual number of companies who are reporting in data did drop during that time. You'll see, for example, I think US, it's around 14, 15 days beyond terms on average. Again, very flat. Then when we look at by certain industries, that does fluctuate. So for example, construction, finance, we're seeing a very different trend to things like retail, for example. So we're seeing more fluctuations when we break it down by industry. But when we look on average, nowhere near as big a sort of increase or jump in days beyond terms as we initially thought it would be. And what we've done as well is we've tried to put together some models as to what we think is going to happen as we sort of move out of this sort of government funding initiatives. So we've sort of put three scenarios in place. So the first scenario, the unfree scenario, is the one we think is the most likely. So government funding will taper off, it will stop, companies return to normal. Then we should see a surge in bankruptcies or delinquencies at that point as the bailouts and the funding stops. But we also looked at sort of what is the worst case scenario. And for example, if companies haven't managed to readjust the way they're doing business, is this going to have a big impact? Funding stops, we then come out of this period, are more and more companies going to go delinquent or become bankrupt because they haven't managed to adopt or change their models during this time? And then a very European term, but the safety car approach. So in Formula One, there's an accident, there's a hazard on the track, the safety car comes out, a pace car, everyone follows it around, but they use that as a timeout to readjust strategy, to look at different options or different ways of doing business. So during this last year, companies potentially used this time, the funding, to initiate different ways of doing business, how they're going to adapt to this sort of new world we find ourselves in. If that's the case, if more companies have adopted those strategies, potentially we're going to see a lower surge in bankruptcies and less delinquency rate when we come out of this situation. So we're thinking option one, the unfreeze scenario, is probably the most likely, but it's going to be interesting to see. Obviously, in Canada and the US, we focus on days beyond term. So there's so many companies that share trade payment data. We're able to see what is the experience when it comes to trade data, what is the experience when it comes to bank or financial payment data. But across, for example, Europe, we've put together this slide which shows what type of data is available on private companies across the world. So, for example, if we said financial statements, in Europe, pretty much every single private company publishes financial statements for the central government, the Chamber of Commerce, which is then made available to companies like Creditsafe. We're able to access that data. So now, as we get towards the middle, the back end of 2021, companies are going to be reporting their financial statements from 2020. So it's going to be intriguing to see what happens on those financial statements, how it's impacted their profit and loss statements during the last sort of 18 months. And just to give an idea, like these are the number of companies that publish financials. So for example, in UK, there's about 3.5 million private companies that publish financials with Companies House every year. So yeah, we're going to start seeing the influx of that data coming in, and then we'll obviously be putting out reports and looking at how that has influenced things over the past 18 months. I think next, Kevin, you wanted to touch upon the import and export stats as well.
Yeah, but before we jump in on that, Kevin, just responses to our question and then another question that's here too. So in regards to supply chain and everything, which should inform your stuff here, Kevin. Yes, folks are definitely seeing disruptions and delays, specifically in transit time, in inability to get raw materials, in that type of stuff. But definitely seeing it, and a lot of folks, or some folks in here, have said that yes, I know it's happening, but it's not really my area, so I don't have specifics for you in that regard. So we are seeing that. And then the question here too of, for what you were just talking about with the unfreeze scenario, Steve, is there any type of timeline that you have for that, or is that just we know it's going to happen if and when, or that's the most likely thing if and when the stuff starts to taper off, all the government funding and everything tapers off?
Yeah, I mean, across most countries, we're sort of seeing that now. Like the funding is starting to taper off, things are starting to get back to normal. So we'd really expect to see that over the next sort of 3 to 6 months.
Okay, there we go. So on to you, Kevin. Go for it.
Great, thanks, guys. So what this shows is the chart of exports over continuum of 20 years from 2000 to 2020. And while the numbers will differ, Canada and US, the trend is the same. And if we look at the downtick in 2020, compared to the US, from January to June 2020, exports were down 25% and imports were down 17%. Next slide. And what we're illustrating here is how connected Canada and US are. So we look at the value of goods that the US exports and looks at their top 10 trading partners. Canada is their number one trading partner in terms of who they export to. Now, the next slide. In terms of who United States imports from, we're number 3. So again, this just illustrates the point that Canada and US, our trends in terms of imports and exports are very similar. And as trading partners go, it's a very important relationship. Next slide. So in the beginning, Nathan put out a question to the group and asking who's been impacted, or sorry, who sells predominantly in North America versus globally. And I think the consensus from what I saw, Nathan, is that the majority of the folks on this call might sell predominantly or only in North America. With that said, we're taking a different view at this point of the presentation. And whether you sell globally or not, we're all impacted. We're inextricably connected by a global commerce community, and it's driven by a complex movement of goods, also known as supply chain management. And this movement is susceptible to disruption and best explained by the chaos theory, also known as the butterfly effect. Jeff Goldblum made that butterfly effect box on Jurassic Park 1 for movie buffs. And the chaos theory simply implies that seemingly small, even imperceptible changes can have a massive implication in complex systems. And what we're seeing is that there's more every year 100 events happening with more frequency. So what we want to do is walk through 3 different case studies to illustrate the point. Automotive industry. So the top bullet is specific to Canada, but what's not specific and what's specific to North America, from January 2020 to December 2020, cars outpaced inflation, the price of cars. New cars increased by 6%, used cars by 14%. And what's driving that and why? The North American plants, there was massive shutdowns due to COVID. They actually manufactured 3.6 million less vehicles due to the shutdowns. There's high demand, low supply. For example, parcel trucks. If you look at the uptick in home deliveries, good luck trying to get a parcel van if that's important to your business. We also found if you start investigating the industry, more people want to purchase a vehicle because they want to avoid public transit. There's less new cars available, as we saw. And when there's less new cars being sold, that means there's less used cars on the lot. Because when you buy a new vehicle, traditionally you turn in your old vehicle, which ends up on the used car lot. In addition, what compounds that phenomenon is the fact that rental agencies have been decimated by the travel industry, and they are the biggest offloading machine, if you will, to the used car lot. So with their reduction in business tied to the travel industry, there's less cars from the rental agencies offloaded to the rental or to the car lots. And there's a lot of people that are looking to purchase a used vehicle. They can't afford a new vehicle. And this segment of the market looking for used, they're also impacted by job disruption. And this impacts the lending process. If you have job disruption, you can't afford a new vehicle, you're looking for a vehicle, it complicates that credit granting process. And Jeff, I want to throw this back to you. You mentioned a trend that you witnessed in the leasing of vehicles and how some leases are being rewritten. Maybe you could comment briefly on that.
Yeah, absolutely. I think last year, as we went through the first start of the pandemic, everybody was trying to figure out how to respond. I mean, everybody can relate to this in their own business as well. Even yourself at home, if you're watching kids or trying to figure out how your commute's going to work now. The exact same thing had to happen in the leasing space. So there was a lot of deals that ended up being kind of rewritten. So if your lease was about to lapse here, in around that April timeframe when everything went into lockdown, what a lot of these leasing companies did was kind of extend that lease an extra 3 months. And it's because not only did they, were not really allowed to have people in to go through and do the inspections and transfer that car across, but they also didn't have exactly what Kevin was talking about, these new vehicles to essentially put them in because the supply chain had been broken. So the industry had to react, and they did so by trying to extend these out. They want to keep those customers active and keep them happy, but did so by kind of extending those leases out by an extra 3 months. So that has compounding effects. So you talk about a little change, like Kevin mentioned with the butterfly effect. Think about the number of cars that had to have extended leases and extended obligations. And then you think about those same people, okay, well, the economy's really kind of shutting down, and I'm not sure if I'm going to have, job security. So I'm not going to go through and get a upper class SUV. I'm going to go through and get it like a smaller domestic car. So it really has a ripple effect across everything that's happened. So huge impact in the auto industry.
And Jeff's point, when you talk about a small car, some manufacturers are actually looking at phasing out the micro car or the mini cars. Additional impacts impacting the industry is the global computer chip shortages. That's impacting many businesses, but every car now has some sort of computer chip or multiple computer chips. And also I want you to put a pin in this point, we're going to cycle back to it, and that's the disruption in resin suppliers for plastic parts. There's a large number of the components in vehicles are made from plastics. And before we go to the next slide, if anyone has experienced megalophobia, which is a fear of large objects, you might want to hide your eyes for the next slide. Next slide, Nathan. Nathan referred to this previously when he opened up the presentation. And so about getting stuck, you might think, how does that impact me? It was pretty big news. And it was pretty amazing, the efforts to unstick the boat, the Ever Given. The Ever Given, as you know, the Suez Canal is the 100-mile waterway, which transacts or supplies a massive part of the world with goods. 6,300 containers were on board when the Ever Given was stuck. This accounts for 12% of the global daily trade. Just to give you some size and scope, 1 million barrels of oil flow through the canal on a daily basis. All kinds of inventory flows through, from food, dry goods, from corn syrups to rice, etc. Clothing, it's a massive industry. Parts, lift trucks essential for movement of inventory. Medical supplies, say no more. That's very critical today. The hourly impact, 3.3 million tons of goods move through per hour through the Suez Canal. That translates to $400 million worth of goods on an hourly basis. If you do the math, that's 6.7 million per minute. And the daily impact is $9.6 billion in trade per day, and it was stuck for 6 days. Next slide. Texas ice storm. Again, this made the news, and if you don't live in Texas, to a lot of people, wow, that's a bad storm. Yeah, that was awful. Yeah, people were without electricity. There was a lot of grief, but other than that, so what? You go on with your life. Well, most items today have some sort of oil. Are made from plastics. And plastics are made from polyethanol. And the ice storm, Texas knew it was coming, but they didn't know it was going to knock out electricity and for how long. So the downtime in electricity actually knocked off the polyethanol plants. And polymers are a byproduct of polyethanol. They were stuck in the pipes when the electricity was shut off. That turned to gel. Water pipes used for cooling mechanisms, they froze and they cracked. What this meant was these plants had to retool and they had to repair. And a lot of the parts necessary in that repair were offshore. So when you start thinking in terms of supply chain and disruption, you're trying to get a plant back online because the major impact it has to many feeder industries is massive. So again, 85% of the polyethanol made in the US comes out of Texas, and a lot of that's supplied to Canada and other countries. And it's used in the manufacturing of many significant goods, for medical supplies, consumer goods. For example, Lysol wipes. They're put into containers made of plastic, so it just doesn't impact basic containers. You have to think of the products that go into those containers. Building materials. I run these industry groups in Canada. We have a building supply material industry group. And this one customer who manufactures windows were saying that due to the supply chain disruption in resins, they could only supply their biggest and best customers, and they were turning away new business. So if you're one of those businesses that's turned away and you need windows to keep your business afloat, what do? And that poses credit manager challenges unforeseen. Hot tubs, consumer electronics, automotive parts. And today, for all the people working in home offices, this is a bit of a flippant point, but yoga pants has become a staple in everyone's wardrobe working from home. Can't deny that. Next slide. So what we're looking at now is the toolkits for credit managers. So a lot of these apply to credit managers that have to grant credit on a global basis, but it also applies on a domestic basis as well. And so from an insurance point of view, more and more companies are looking at insurance, but we find that there are some limitations. For example, there's limitations on coverage of insurance. There's no guarantee that every account you want to insure is going to be covered by insurance. And with most insurance companies, they still put a responsibility on their customer to provide some sort of credit look. And it can be a bank rating, it can be reference requests, and all these have very specific requirements that have to be met when you do these, and they're time consuming. A lot of companies are using vendors to supply this last requirement. And what that means is insurance companies also accept a credit report from whatever agency, and the right type of agency that has to be credentialed. Letters of credit. This is used globally, but I find this is also used domestically as well. And some of the challenges that we see are the legitimacy of the letter of credit and the creditworthiness of the bank. Not every bank has the ability to pay out a country risk. Some foreign countries, the bank might agree to pay, but there can be challenges whereby the actual country will not allow the payment for a number of reasons, and sometimes it's political. Complexity or lack of consistent global standardization. So what that means is there is no global standard by which these letters of credit are governed. And there's also an issue of authenticity. So are the letter of credit that you received, is it actually authentic? Is it real? Or is it something made with software?
So Kevin, as well, I think like a really interesting point you mentioned before this call. You've been interacting a lot with credit managers, and you've seen like in the construction and house building industry, somebody who's I don't know, a builder, a small building company, for example, they're taking lumber. They've got a $50,000 line of credit today. All of a sudden, the price of lumber is 3-4 times what it was. Does that mean the builder still needs the same amount of lumber? Does that mean they'll get access to 4 times the amount of credit to buy the same amount? That becomes really interesting, but very difficult for a sort of credit manager to sort of look at that situation and figure out how to handle that, because that's unprecedented and how things like these commodities have gone up so rapidly.
Yes, that's a great point. And for the sake of time, I kind of blew by some of those traditional case studies. But yeah, lumber is a great one, especially for people in the U.S. If you look at the housing boom, it's on fire. And we're experiencing the same thing here in Canada. And the price of homes are just, it's gone insanity. It's just beyond insanity. And so to Steve's point, we had actually one of the major lumber distributors that distributes to the Home Depots and the Lowe's, et cetera. In one of our industry groups, they were lamenting on the fact that, yeah, to Steve's point, if it costs a builder $50,000 to build a house, and the credit manager's granted him $50,000, that $50,000 is now worth $150,000. What do you do? If you've said he's only good for 50, but now he needs 150, what will you do? Do you now give him 150? Because if you have a loss, the cost or the value of that loss now increases threefold. Or if you only maintain the 50,000 credit limit, what does he do? Does he only build a third of a house? So credit managers, because of the supply chain disruption, they're forced to make other evaluations on how they're going to treat that client. And a phenomenon we've seen in the industry is more suppliers and even banks are working with their clients to the best of their abilities, because they look at it and say, if I don't work with them, if I'm strict, if I cut off his credit, etc., I have a sure loss. If I work with them and we do turn the corner with vaccinations, etc., the petered out of COVID, I have a customer probably for life. And so now credit managers are faced with the new dilemma. What do I do? Okay, next slide. So this isn't really a credit tool, but it is a credit tool of sorts. So traditionally, compliance checks is basically checking whether or not an entity shows up on any sanctions list, PEPs lists, anti-terrorist watch lists, et cetera, and so on. They don't have credit history, but what they do is speak to whether or not you could experience an issue unforeseen to your business. There's hidden risks. I'll give you an example. So I have a brother-in-law in tech. They sell global solutions, and they were selling to a company in Iran. Turns out that company in Iran was owned by the Iranian government. His company was bought by a big software company, and he ran the business as a unit of the software company. And he received an email, and it was an immediate cease and desist with this Iranian company. And when he drilled down and was inquiring why, it turns out that the Iranian government is on some of the do not serve U.S. sanctions lists. And if you sell to a company on such a list, you can be precluded from any future government contracts as well as existing contracts. It can also impact financing with certain banks, et cetera. So we're finding that we're experiencing more conversations, both domestic and globally, with respect to compliance checks. And when it comes to reporting agencies in the old days, a reporting agency was a credit report. And that's how most people probably look at reporting agencies. But most of the agencies that are larger in scope, we've been forced to change how we transact with our customers and the solutions that we provide back, because the industry demands that. And so when you're picking an agency, whoever that is, and there's a lot of good agencies out there with different specialties, if you will, and different capabilities, but you're looking for, traditionally, what you want to look for, someone that has the biggest coverage, or the coverage that's specific to your geography that you sell to, whether it be global, North America, it could be Mexico, Latam, Canada, et cetera. Global port of global scoring. So what that means is you're looking for someone that has a one source solution with current technology that links all the properties together. And what we find also is that because of the different availability of data sources from country to country, it can impact the type of scores that are available. But a good agency will blend those scores, will create algorithms that create a common score that's common across all the geographies. So whether you're looking at a credit report in the United States or Canada or Mexico, you'll have a common score, so you don't have to make adjustments every time you're reading a report from a different geography or a different country. Suite of services, you're looking for, as we've talked about the supply chain disruption and how that impacts credit. We don't know when companies are impacted by the disruption of goods, do they have the legs, the financial war chest to continue business? We're finding we're having more conversations where companies saying, I need to monitor. And when Jeff was talking about the economy in the beginning of the presentation, one of the phenomenons we're seeing and hearing discussed and over and reoccurring with banks, with industrial suppliers, et cetera, is the unknown of the pent-up delinquencies that people anticipate in the future. What's common, or the common consensus, is that they are going to happen. We just don't know when. And so we're having more and more conversations about, can you help me monitor my customers? I need to know when the worm turns. That's become a really big part of our conversations. And also analytics. Can you help me understand? Can you provide me analytics on my customer base to help me unlock the secrets, spot the trends, so I can be proactive? So that, again, is just part of the suite of services available. There's regional differences I spoke to in terms of what information is available. Navigating those waters, whether you don't deal or you might find yourself dealing with other countries in the future, navigating the waters and understanding those differences, a key partner will help you navigate that. So again, choose wisely. There's different legislative impacts on what data is available. And Steve, maybe I love when you speak to the different sources of data in Europe, and then in terms of also the cultural differences that you can see on the second last bullet. Maybe you can speak to that.
Yeah, I mean, especially the data sources. I mean, as we mentioned earlier, like across Europe, Asia, financial statements on private companies are a lot more freely available. And you find with scoring models, the credit scoring models will take into consideration more financial data and be more weighted on those elements, as opposed to days beyond terms or payment behavior, like in Canada and the US. So that's a big difference. I know, Nathan, you've run a couple of webinars as well with our friends, our partners that we work with in China, and they've given some really interesting insights into the market in China and how it works. But one of the big differences is like the difference between invoice and receipt. So often in China, you'll find that a company that's bought goods will offer a notice to pay. They will say, I'm now ready to pay for these goods, at which point an invoice will be issued and it's paid immediately. So things like days beyond terms don't really exist in the same context that they do here. And understanding all of those sort of cultural differences is massive. Even somewhere like Japan, like we run a credit bureau in Japan, and the big players in Japan have thousands of field researchers who go out, they visit companies, they sit down with a financial director, they interview them, they ask them about their hobbies, their personal life, their personal health, all of these crazy things in a questionnaire. They fill it all out. That's then put into the form of a credit report, but it's a very different the sort of quick database information that we're used to here. Is all about the personal relationships, doing interviews, and it's a totally different culture. So understanding those is it's very different. And I think, just to finish off as well, Jeff, you wanted to just mention a couple of things that we're monitoring, things to look out for as we go through the rest of the year.
Yeah, absolutely. So one thing that is consistent across Canada, US, and really the rest of the globe is that governments have stepped in. They've offered funding in to not bail organizations out, is really to keep things sustained. And really the trends that we've seen here in Canada, especially as we had our federal budget announced last week, is there isn't really any more funding going to be coming in the immediate future. So basically what's been provided out is what's there. And so as we see all these negative occurrence cycles start to slowly unwind, we are going to see a pending surge in delinquencies, collections, and right into bankruptcies as well. It's going to be happening very, very fast. So really, it's really on and us as credit managers to really monitor what's going out there, be aware of your portfolio. So anybody who may have been on the cusp before, be prepared that likely going to be part of that surge. So use the tools that are available to you. And that's really kind of the second point here is make sure you have crystal clarity on what's going on. So the data you have access to, you really need to think differently. These are unprecedented times. I hate using that phrase, but it really is. You need to act differently because some of the scenarios that Kevin went through, they haven't really happened before or in the recent history. So really going through and understanding how that impacts you, and to the point as well as we're all a community. You know, the reason that we have these discussions and we share this knowledge is because things happen that you don't expect. Talking to yourself as peers, talking to us, as well as what are we hearing? What are the groups talking about? And really the other point I want to get across is that you are the unsung heroes in these conversations as well. Being able to go through and talk about builders in the construction industry and what to do and how to make sure that you're supporting them as a business so that they're there post-pandemic, and also making sure that you can, protect yourselves, protect your business. So you're a critical part of the economy, and we appreciate the work that we have been able to do with you in the past, and very much so open to conversations as the pandemic hopefully subsides. We're here to support and really, really appreciate your feedback and engagement.
Yeah, absolutely. And Jeff, as you mentioned there, and as we're running up towards the end of time here and everything, just wondering and I'd love for each of you to answer this. What would be that one thing that really big piece of advice, or that one bit of encouragement or whatever you can give to these credit managers that are on here as they're seeing this and going, okay, we knew this was coming. Most of them have an idea that, that I'm sure that nobody's completely shocked by any of these trends or anything. But how can they mitigate those risks and at the same time take advantage of these opportunities that are out there to, like you were talking about, I think it was maybe Kevin was talking about, create that customer for life, by working with these customers and doing that. So what's kind of that thing that they can really start on today that'll help them as they move forward into this?
Perfect. So I will start. So really what we're seeing in terms of not only financial institutions, but suppliers across Canada and a little bit into the US as well, is that everybody's trying to make up for the 2020 shortfalls. So what that means is they're doing a lot of marketing initiatives, like trying to really get out there to make up for those, what's going on. For any onboarding or net new companies that you're starting to work with, that's how you can really understand trends to adjust your scorecarding and the decisions you're making. So being able to understand a profile of where someone's at, where are the needs coming from, where are the next set of demands coming in from, use that to adjust accordingly as well. And just try to segment wherever and however you can to make sure that not only you're enabling the right companies, but you're protecting yourselves from the ones that are going to be on that list of the kind of the 20 or 20% or so that are going to slip off. Kevin or Steve?
I'll add what Jeff said. When we looked at some of the case studies of disruption to businesses, the one thing that we have to take into consideration is that those lost sales, when a clothing store doesn't have clothes to sell, when there was a case study of a hot tub plant in Buffalo on track for the best year of their career, and they were shut down with the Texas ice storm. Those lost sales aren't coming back. And so it's incumbent on the credit managers to really respect and understand their customers on a more intimate level, and work with them to help them survive through these tough times. But what becomes critical in that equation is not just that intimate relationship, but also whoever you're going to use, whatever sources you have, is data has become the latest commodity to really help companies stay ahead of the curve, to understand those micro changes that can come like a tsunami. So I would encourage everyone to really look at how your company leverages data, both internal and what third-party capabilities are available to use that data to really stay ahead of the curve.
Yeah, to reiterate what Kevin and Jeff said, I think now is more important than ever to be using services like monitoring, to be understanding not just the company you're dealing with, looking at the ultimate beneficial owners of that company, the corporate hierarchy of that company. Are they dependent on owners overseas and things like that? So really understanding as much detail as possible the companies you're dealing with, and getting ahead of it. So as soon as we see what impact will start coming through as the government funding and loans stop, having a sort of daily approach and looking in real time at how things change with those customers.
And Nathan, I can add one more comment, and that is
Please,
more and more more and more where, again, we looked at several case studies as impact disruption has on business. But if you're a Canadian Tire, it's a big retailer in Canada, or Home Depot or a Lowe's, and you have some suppliers that can't supply their product for whatever the reason, that has a major impact on running your business. So we're finding more and more our clients, the conversations we're having is that they're looking at these vendors through a credit manager's lens, right? So if their business is disrupted, again, do they have the legs to weather the disruption, the storm, et cetera? So again, more and more companies are pulling credit reports on their vendors to do that form of assessment.
Absolutely. Yeah. It's not just a downstream effect. It's that upstream too. You gotta look both ways.
Exactly.
That's a great point, Kevin. Great. So guys, thank you so much. We're running up on time here, so I want to respect everybody that has joined us, their time and everything. And I wanted to thank you guys so much for providing your expertise, all these insights and everything. Folks, remember, all of this has been recorded, so you'll be able to go back if you missed something or you want to go back and look a little more in detail at some of these charts or anything. Those are all going to be available for you in a follow-up email that you can access anytime. And we have a bunch more of these type of webinars coming up. We're always doing them. All of our webinars have been recorded, so they're all available. And we have a bunch more coming up, like I said, on automated financial decision making. On Steve even mentioned we've done in the past some stuff on China. We've got that coming up. We've got stuff on just what goes into a credit score and how is it made up? What actually happens in the building of that? We were talking about some of the data points and everything here, the analysis that happens. We've got a webinar coming up on that. But you can find out about all of our webinars, both past and future, just by going to creditsafe.com/webinars and register anytime and set those up, or listen to any of the previous ones at your convenience. So thanks so much for joining us, gentlemen. Thank you for being here today and for all that you provided. And we will see all of you another time. Have a great day, everybody. Bye.
Thank you, Nathan.